Good morning, everybody. The December trading month begins in earnest this week. Tons of data to come, and all leading to the last central bank meetings of the year. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. Good morning, everybody. Yeah, doing well. Ready to start the week once more.
Yep, here we go. Right, let's get something out and in the open, done and dusted before anyone asks. Those who still might need to ask. Gold, stop run, stop flush, low liquidity, time of the day. That's it. No war headlines, no Powell headlines, no nothing. This was purely a stop run. How do we know? Boom, smashed through the level on the open, came all the way down since then. Now it's holding back below the level. Okay, so none of you need to ask questions about gold to do with that move. Just getting that out there in the open. Everyone's been scratching around for the reasons this morning. So don't believe the hype, as they say. Anyway, cracking on to some of the other news. Over in the Bank of Japan, BOJ's Noguchi says to achieve our 2% inflation target, we must see price rises backed by sustained wage increases. Says the rise in inflation is mostly due to cost push factors amid higher import prices. So sticking well with the script from Ueda on that comment. Then says, while annual spring wage negotiations this year achieved wage hikes unseen in 30 years, we've only just reached a stage where the possibility of achieving our target has come into sight. So this is a pinprick of light at the end of the tunnel, Kay, they're seeing for inflation.
Yeah. It's the same, as every time. They are still sending us to those wage negotiations as well. But yeah, we're still in the same scenario basically. I don't know what to add really.
Yeah,
it's gonna continue. It's probably going to be okay. Market is trying to buy yen. And as we've been saying last week, perhaps with some reason against some other currencies, against some currencies. Well, dollar yen is of course the main instrument, but then if you look at the crosses, they are starting to finally show some sign of weakness or topping out. Let's put it that way.
Yeah, very much so. I'm still getting the twitch that they're painting themselves a bit into the corner with this talk of wage hikes. There's a growing expectation that these wage hikes are going to come in strong, and cool. I don't know what happens if they don't. That's probably a big shit hit the fan moment for yen.
Yeah, that would be an issue. That would be a real issue. But you know, Japan being Japan, once they've set it in, I don't see the main companies in Japan, because if you look at the bigger ones, and exporters especially, like the car makers or the heavy machinery makers, they've had good years, or they are having good years, and that should hint at the wage negotiation going to go okay. Now, if they're going to get, if the union's going to get their 5-6% or whatever they're asking for, I don't know. But as long as let's say the real wages are going to climb above the inflation rate, it should somewhere still be a positive, right? And I don't think many of the Japanese companies will go really to fight against it. Not like just the year after their first round of hikes. So yeah, I think all in all, my base case is still they are going to be okay. Those wage hikes negotiations.
Yeah, and but as always, we should probably prepare for the worst and then see what happens if
always, yeah.
It does. Yeah, exactly. Right, a bit of data out this morning. Switzerland with their CPI numbers. Obviously, the SNB meeting is upcoming. Their quarterly meeting, and inflation going the right way. Year on year, CPI 1.4%. versus 1.7 expected and prior. The EU harmonised measure as well, also dropping. That came in at 1.6% versus 1.9 expected and 2% previous. So that's good news for the S&B in terms of not needing to hike again. Would you think, hey?
Well, absolutely. I don't see why Jordan is still so hawkish and continuing to buy Swiss franc as well. We will see the report. I thought I saw some report out that apparently the reserves are still coming off, but they perhaps are still the October data, so we might need to wait for the November data still. But if they still were buying Swiss, I think it should come to an end pretty soon now. They're well within the target range, which is, what is it, 1 to 2 or 0 to 2% or so. They're well below now the 2% mark. Yeah, I think they shouldn't be hiking anymore. No.
Yeah, exactly. Some other data you can just see there, a few bits and bobs from Australia. Retail sales coming in as expected, minus 0.2%. In Germany, trade data out of there, and another situation where you can actually see the trade balance improving, the surplus improving to 17.8 billion. But again, it comes on slower activity numbers, both exports and imports down. Were both expected to rise, but they didn't. And the fall wasn't as bad as last month, but again, it's still negative numbers. So that's when good isn't so good when you look at what's happened activity-wise. So no real pickup there of significance in Germany, except that activity maybe isn't falling as much as it did last month. Over in Spain unemployment change was down 24.6k, was expected to rise 28k. So I think that says more about the forecasts than what's going on in the data itself. On the ECB front, ECB's Villeroy says rate hikes are over, absent of any significant shocks to hit us. Says we can look at cutting rates when the time comes next year. ECB's de Guindos recent inflation data is good news and has been a positive surprise, but it is too early to declare victory. An increase in wages can still have an important inflationary impact. Our monetary policy stance will be data dependent. We will move from meeting to meeting. De Guindos is one of the people who have been touting a jump in inflation coming up in the latter part of the year, maybe early next year. So that's obviously something we need to keep an eye on. Coming back to last week's data, just to run the rule over what went on there. We obviously had Canada employment data, which came out fairly positive. Employment change was up 25k versus 15 expected. The revolving door spun the right way. A big jump in full-time employment, but quite a significant loss in part-time employment. In normal times, that's a good number. It is a good number, but the thing that struck me is that you tend to see a lot of part-time employment at this time of year. And I looked back over the numbers, and for the last 3-4 years, part-time employment had been positive at this time of year, which again indicates seasonal hiring. So maybe that's a bit of a signal that there hasn't been a lot of holiday hiring, which might put a pressure on retail sales and things like that if firms didn't think that they needed the staff, services particularly. But you can't change the fact that it's a positive number on the full-time employment. This one we might need to watch carefully next month, just in case it all does a bit of a flip around. But apart from that, all looking fairly good, although the unemployment rate did tick up as expected to 5.8% there. Wage numbers as well staying unchanged at 5%, so that's looking solid there as well. Might just give Macklem a bit of pause for thought that wages are holding up, but again, with inflation coming down, it means wages are turning further positive, which is good news for the economy. Then we had some of the PMI data as well. As you can see, Canada went backwards in its PMI. The US, the final numbers out of the US unchanged at 49.4, which confirmed the move into contraction from the flash. Construction spending looking A-OK over there, 0.6%, still keeping positive tone to it. Then we had the ISM manufacturing numbers from the US, and down on the headline, 45.8, so that was a soft hit straight off. But then when we look at the components, new orders were higher, so that was good. Whether it's just a bit of a one-off event, we don't know. And well, what we do know in all this is that reading through the comments, the respondent comments you get the report, a lot of the activity has been driven by people drawing down inventories. That means they're going through their stocks rather than ordering new stuff to fulfill orders. That might have given us this bump up in new orders, but what's bad about that is that if people are digging into inventories, not ordering more, and this is on the supply side, that can impact growth down the line because there's no chain. People are just using what they've got rather than ordering new stuff. So that's a particular red flag on the inventory comments there. The other stuff, prices, that jumped up as well. Sorry, it was employment that fell to 45.8. Sorry, the headline number came in largely unchanged, and last month was expected to rise. So employment looking softer, prices looking higher. That's going to get a few people scrabbling around their notes for the NFP this week. What did you make of that data on Friday yourself, Kay? Canada jobs good, ISM meh.
Yeah. So about those Canadian jobs, I think we'll see probably surprise numbers in December and January, because traditionally they are doing a lot with their jobs, like laying off people and then rehiring them, or doing much more part-time and stuff. So just an early one for the calendars. Watch out those next two, or perhaps we have to take this one into account as well. Those 2-3 jobs numbers, we could see some distortions because they traditionally happen over the end of the year. So that thing, I think the base number was okay. It's always better to have full-time employment coming in, but again, is that number not fake? It's a real number, but is that going to be subject to a lot of changes over the coming months? That is possible as well. Yeah, for the rest, the ISM was lukewarm. Of course, as people know, we are watching those employment indexes, because there's still a big domino, this the jobs market. So they are continuing to come down. I've read somewhere that thanks to deals, trade with union deals and stuff, the NFP may be a bit distorted to the top side, or this week. I don't know when those numbers will have been taken, but it's for sure a market that or one of the pillars that we have to continue to monitor, perhaps more than prices, for as long as prices don't start to jump to those 55, 60, 65 levels anymore. If they remain around here, I think move on. Yeah, that's about it. I liked the Canadian number, and the US numbers, I don't know really. I think it's going to be more interesting. When is it? Tomorrow that we have the ISM services in the US. Yeah, I think those could be a bigger mover, right?
Yeah, particularly on the jobs.
Sorry?
Particularly on the jobs.
Yeah, exactly. Absolutely. So those will probably be a bigger market mover. I think what we saw on Friday as well, numbers or not, there was still a lot going on around the turn. People were hammering the yields everywhere, especially in the US. And now I think December can really start, because this week is already going to be a week where we're getting a lot of data. We have Powell out of the way, and I think let's let December start now in for real, right?
Yeah, exactly. So over to Powell we go, because he was the main event, or was tipped to be the main event of Friday. Let's go through a couple of his comments first. He said he was prepared to tighten further if it became appropriate. Incoming data will tell if the Fed has done enough or needs to do more. The Fed doesn't need to be in a rush now. We are getting what we wanted to get. He did say that credit card usage and defaults mean that spending may be slowing. So he's obviously seeing an increase in those. And he said, based on limited data available, we think GDP is slowing. That's a bit of a kicking in an open door, because we know the US has been printing some high GDP numbers the last couple of quarters. And given everything that we're seeing in the data ourselves, it'll be a bit of a hard push to see those sort of numbers coming in for Q4. Obviously, we're not going to get that till the new year. Now, the biggest take I got from Powell was a line in his printed speech, which said it would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance, or to speculate on when policy might ease. We are prepared to tighten policy further if it becomes appropriate to do so. So Powell said exactly what I thought he might say. He stuck to his guns, keeping the message in play that they may not be done with hikes. Rates are not sufficiently restrictive. They're ready to do more, blah, 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 blah. It was a bit of a rinse and repeat. There were some concessions to what's been going on. But this time the market has stuck two fingers up at it. I'm not saying it doesn't believe him, but it's seeing the data for what it is, the recent data, and it's saying basically there is no way that another hike is coming based on the data, and that cuts are becoming increasingly likely. We've seen that all in the repricing of rate expectations and the like. So the market pretty much hammered Powell on Friday. We saw yields coming off, the short end particularly waking up to the message. It had been holding up pretty well. Now we look at something like 2-year yields, and let me just get rid of that. And that. So we have seen the market now finally, well, at least the short term, finally showing that it's taking note of what's going on in the economy. 1-year yields not off as much. If you take that from sort of, that's what the market's pricing. Well, it's probably a bit more now, 100 basis points. We've not come off too far, but we still come off about 25 basis points over the last couple of weeks, particularly on, well, since last week, we've come off about 25 basis points. So that just shows you the market is sitting up and taking note. What does that mean? That means that Powell is in danger of letting the market run too far. His comments on Friday didn't halt that. It means we may get a stronger message from the FOMC. What the market is doing, particularly at the short end now, is loosening those financial conditions. And this is what he will be wanting to fight against. Maybe he's allowing a little bit to go, because that will obviously help with the economy, but he doesn't want it to go too far. So keep an eye on these short end yields this week over the data points. You probably need, whatever asset you're trading, keep a yield chart up, and keep an eye on that, because if we start getting something like the 2 years down, 4.25%, 4%, that'll be pushing gone too far space. If you get my drift, that'll be when we're probably pushing too far the other side of the boat. What do you make of Powell, Kay? The market pretty much said fuck off.
Yeah, I mean, that's what the market does. We've seen it on the one side, we've seen it on the other side, and that's what this market does. Now we are in full on who's going to cut the most, and let's see to where we can push it, or up to where we can push it in the bond market or in the equity markets, before they come out and say like, hey guys, I mean, this is not what we want to see. I think the market is already pushing a bit hard. yes, you can still, because I think we're now expecting what, 125 BPs or so cuts in 2024.
Yeah,
It's just like the pendulum swings, right? I think we have seen the bulk of the move, unless you get that ISM coming out extremely crappy, a very negative surprise on the labor report. Then the market will likely push harder, much harder, and then the Fed will probably have a too big a job to even try to stop it, but they might need to or will at one stage. But everything, all else equal, I think we've seen the bulk of the move right now. That's what I think. I mean, and we are likely. I'm not saying that yields are going to go back up, but if you look at what I specifically look at the differentials, I don't think that they are going to go much more into the negative towards the US yields right now. So I think the bulk of the move has been seen, in my opinion. Anything more right now, if nothing else collapses around it, is going to be too much, in my opinion, right now. I mean, again,
yeah,
we need to see the rest of those data.
yeah. I think you know, for sort of looking at a trading sentiment this week, I think you've got to go with a path of least resistance. Okay, if the ISM comes in softer, I think we do see a further reaction down in yields and the dollar and whatnot, and the market all doing its cut dovish thing. Because on the flip side, if you get good data, it's got to be, you know, super hot data to turn this around. So if even if the ISM tomorrow comes in relatively good employment, good in, prices paid numbers, good headline or whatever, unless it's something that's real gangbusters, and even then, I don't think you see more than a pop up in yields, knee jerk higher in yields, a knee jerk jump in the dollar. And we're not talking anything significant, and then that gets sold into, because the market has got its bone, it's got its cut bone. It's going to take a lot to turn it around, but how far more it can push on that, I don't know. But I think for now, I wouldn't be surprised to see 2 years coming down to 4.5, maybe having a look at that 440 on soft data this week, and we've got ADP and everything coming out. So yeah, I think the path of least resistance is for yields lower and the dollar lower if there's soggy data. I think good data gets sold into, but you have to think the lower we go in things like yields and the dollar, the more the chances there's going to be a stronger pushback when we get to the FOMC. So just keep that in the back of your mind. Don't think, oh, right, yields are going to go to 4% and keep going. Once we get to closer to that FOMC and that inflation data next week, the market's going to start taking stock. And then that's when you should expect, as I say, a stronger pushback potentially from the FOMC. That doesn't mean we won't carry on down, but it means that it might be putting a bit of a pause to these dovish calls. If they are strong, we'll get a natural rally in yields, a rally in the dollar, and then that will probably dissipate for the rest of the year, or coming into the new year, the market will get straight back on the cut wagon again, and we reverse any higher moving yields in the dollar. Anyway, that's my view this week going forward. Just looking at one other headline I wanted to bring you as well. I mentioned last week that just seeing a few more job cut headlines crossing the wires. Spotify were out to say they're laying off 17% of staff. That's the third round of job cuts there at Spotify. This 17% equates to about 1,500 people. So not a huge amount, but it's just another headline on job cuts. And all these little headlines, you know, 900 people at Barclays here, 1,500 from Spotify. Not big numbers, but it's a trend. And that's my biggest take from all these headlines. We're seeing a trend in job cuts coming. Whether it develops into anything, whether it means anything, I don't know. Anyway, so that's it from the headline front that I've got. Kay, you got anything that swung on your radar this weekend or this morning?
No, I wouldn't think so. Yeah, we put a bit of stuff in the in the news and research room, but really, is there anything really market moving? I wouldn't think so, you know. Just the
Yeah.
one thing that I saw though is that in China, it seems that they are still running into borrowers issues, and it's just articles coming in, and we never know whether it's like an opinion or real data, right? But it just shows that they are not out of the woods yet, and we have to be perhaps a bit careful on how we view the economic and the especially the loan situation over there. They're still not out of the woods, so bit of positive spin to things. Market maybe through the worst, yes, but is it turning? Is it zooming ahead on a better note? Not yet, I would argue.
Yeah, no, I agree with that. Always round. Right, let's have a quick look at what's coming up this week because it is a busy jobs week. We got factory orders and durable goods revision later today. Tomorrow we start getting some of the final services PMIs, which will culminate, as mentioned, in the US ISM Services Index. Same time we get JOLT, so we get to see what's happening in the vacancies data over there. See how things are. The ratio between that and unemployment is tightening up. Some GDP data for Australia. That's going to be Q3 stuff, obviously. Then we get some retail sales from the Eurozone, then ADP, which will give us a first indication of whether there's anything big happening. And I think for the NFP report this week, we're expecting around 180,000 is the general gist right now. I think for this report and for its importance on the FOMC, it's going to have to be a big variation. If we come in, I don't know, 150, 100k to 250k, I don't think the market's going to bat an eyelid. If there is something shocking out, i.e. we get another big, 400, 500 plus print or a negative number, that's going to be important for last minute Fed expectation trading. So that's my thought. So ADP might flag something like that. If it comes in, 20, 30k either side, the market's going to go, yeah, bothered. Then obviously we have the Bank of Canada coming in. Oh, sorry, Tuesday we've got the RBA. Forgot all about that. Tuesday we have the RBA tomorrow. I don't think we're going to get much from that, bar the same old lines. Certainly don't think we get any rate movements. But we'll get the continued message that another hike is on the table if inflation doesn't come back fast enough. Bank of Canada, I think, is probably just a rudimentary meeting. We're happy where we are. Nothing to worry about. See you next year. Have a good Christmas. Do you think anything's coming from either of those two, Kay?
RBA CPI, Australian CPI went down. Perhaps they can say that they are where they want to be. But again, yeah, but sorry, I agree with you. I don't expect any fireworks. We are on relatively important levels on Aussie dollar, so it could be a mover just because of technical reasons. And the Bank of Canada, yeah, well, McLeod has already gradually shifted his hawkish stance towards more neutral. I don't think that that labor report that we had on Friday is going to change that picture much. So I guess the Canadian dollar will probably move more on energy to start the week than Bank of Canada expectations.
Yeah, very much so. And it's not on there, but we also get tonight, early tomorrow morning, the Japanese Tokyo CPI, which could be a bit of a big number ahead of the Bank of Japan on the 19th. So just keep an eye on that one tonight as well. Into Thursday, we get some retail sales data, some final GDP numbers. That's all in the rear view mirror now. Challenger job cuts. I'll be keeping an eye on that one just to see if anything is showing up that we haven't seen in some of the press stories that I've been pointing out. That's Job cuts report, not watched by many, but it gives you an indication of potential layoffs that have been announced. So if someone announces they're looking at 1,500 layoffs, this is the report it will appear in. Those layoffs don't necessarily mean final job cut numbers. It's an intention to lay off. So that's what I'll be looking for there. Friday, obviously, it's going to be the US NFP is going to take the highlights. We do get Michigan numbers after that later on, so we'll keep an eye on the inflation expectations for that. Then into the weekend, we've got some CPI data, PPI data from China, so we'll see whether this deflationary mood they're in is changing at all, because that will be something to keep an eye on in terms of them easing further. Anything else grabbing your fancy this week, Kay?
No, there's plenty, already plenty enough. Is Lagarde supposed to speak again later today?
Is she? I've not checked the speakers yet.
Yeah. The one thing that I would kind of highlight, because there's a few of us in Swiss positions right now, is that we should have, and I don't know whether it's tomorrow or the day after. Magix always has that calendar in his mind. We should have the Swiss S&P FX reserves coming out. We have seen them come off for in months where they actually should not have come off, indicating that they were still buying Swiss franc. But I would pay close attention to see if they are still intervening to support the Swiss franc. Well, looking at the CPI data, looking at the latest economic data as well, they should not. But you never know with Jordan and his friends. It seems as he is in a kind of mood saying like, oh, we still got a few FX reserves in the books, let's sell them. So we keep an eye on that one. If and when it comes out, we'll keep you informed in our chat room, of course. But that could be somewhere, if they don't buy Swiss franc anymore, could be somewhere a signal for Swiss traders to say like, okay, this time it's really enough. You know, we have seen Swiss franc strengthen quite a bit, has been very, very strong over month end and on Friday as well. I have the suspicion today that some of this yen strength has to do with Swiss yen again this morning. Could be that you're selling a 0% currency versus a one that isn't costing you too much. Buying, sorry, the low one, and having very little funding to pay. But that's one of those, together with euro yen, that came off pretty hard since last week and then start of this week. So keep an eye on those FX reserves, I would say, because they could be a driver. If they continue to buy, then we really don't know where they going to end up in their FX reserves, because they're already back well below pre-pandemic levels, well below. We are talking about 2015, 2016 levels, where they are now. So if they continue to buy Swiss franc, I don't know when they are going to stop really, but I would suspect that we are closer to an end than to the beginning of.
Yeah, just a quick question. When do the Swiss close up their let's call them the trading books for paying out the cantons? You know, when they do their dividend payouts and stuff. Is that calendar year end or is that financial year end? So
well, that's one that I have to look up on the SMB page. Yeah,
because I do recall that they can be a bit active at the year ends, because obviously a lot of people close up their books at the year end, even if it's not fiscal year end, it's calendar year end. But okay, I'll leave that one with you, mate.
Yeah, I'll have a look into it. I'll make a note of it and see what I can find.
Cool. Right, quick look around the grounds. Looking at the euro. Ali, good to see you, mate. Busy scalping away, I see. What are you doing now? You are short 108.70 with a stop at 19.10. Okay, so you're there or thereabouts. No real surprise to see that this zone I've been banging on about forever is playing up again. We've had another move down there on Friday to the bottom end of it, 108.30. That's proved itself yet again. I'd be wary of a secondary quick move down there like today if we have another test down there pretty quickly, I'll be worried that we're going to break and head a bit lower, maybe down to the big figure and this fib 38.2 down around the 108 handle. So just keep an eye on that. It's still a bit undecided what we want to do here, whether we want to move back up or indeed move back down. I think your stop is sensible-ish at 109.10. 109.10 is a bit of a level I've got that I've been pointing out for a while. So just bear that in mind, Ali, that you've got to stop right bang on the level. I'm not telling you to adjust it or anything like that. I'm just making sure you're aware that it's a bit of a level. You don't want it to hit that stop out and then come all the way back down again. So just consider that. NFP competition, it's coming, Ali. Hold your horses. It's only Monday. I've had a busy Monday already. I'll have the competition by latest tomorrow. So make sure you're getting quick with that, Ali. I'm sure you're busting a gut to get your guests in for that. Dollar yen, as mentioned, now we're looking like we're properly holding below 147. That, as I said, might be a pretty significant move if we do hold that. I've still got the itch to short this, but I'm looking at chasing it now, perhaps. But I'm sitting on my hands. I'm looking to see if we do get a push up on the Fed or something like that. We hit the 38.2. This is a move that is just part one of the year-long trend. We've had this move all the way up from down here this year. This is just this phase of it. So 38.2 is being tested here. So it's important for this trend to see if we break or hold. At the moment, there's no signs that the rally selling mood of the market is abating. But as Kay mentioned, it might be that we start to find ourselves a bit stretched in terms of what we're doing as far as pricing the Fed goes. Obviously, on top of that, we've got expectations for the Bank of Japan and their tightening, which is playing a part in this as well. Cable trying a few times to get through this 127.20, this 61.8 fib, keeps banging its head. So again, no surprise to see it pull back. It's nice and healthy price moves we've got here, where you see the levels tested, you see the support tested. For those of you who like scalping, there's a good 100, 120 pips to try and grab within this. And really, you've got to go with whatever side we break first. If we break up through 127.20, then we're probably heading much up towards 128. If we're back under here, if we finally crack back under this old fib, then we're probably 125 bound. So yeah, just go with the flow on that one. And Ali, you're in Euro Sterling. It's had a little bit of a bounce off an old level, 85.50 down here. Quite a decent bounce, but until we get back above 86, 86.10, this current move is still in play. This bearish trend is still in play. 85 is obviously my big level down here. It's weird. It's taken 10 days to undo pretty much 4 months of moves. So a very fast move. So I think potentially, given that we're pricing ECB rate cuts and a more hawkish holdout in the Bank of England, I think we probably might see some stretch levels down here. I'll be looking at this 85 level again to add back into my longs. I'm still holding a little bit for when I traded this back starting in July. So I'm going to be looking at this level again to get back into longs there if I feel that the sentiment is running a bit too far on ECB dovishness. I'll keep it tight below 87.70. I'll likely be out, so there's no need to go heavy on a trade here in terms of risk. We know it's a big historical level, as you can just about see there. Hence why I put my faith in it last time. So yeah, another test down there, and I'll be sniffing most definitely. Kay, did you want to have a little look around quickly just to finish off our Monday?
Yeah. I was just going to say to Ali about the Euro Sterling. I'm not saying you're wrong by no means, okay, but I do think that if you look at the speed of that move that we had, a lot of it was also driven. There's a bit of discrepancy, I know, between the European and the UK data, in favor somewhere of the UK data, but it's been relatively mild. So if you look at it when this happened, a lot of it is an end of month move, okay, and and then the next day, that's which was end of week as well on Friday. I was short for a part of this move, but I've taken them off just because I just don't know right here and now. Yes, you can of course be right for as long as below 86, 86.10, as Ryan already said. That's exactly that move, and if that level, and if you look at that latest spike on, what was it, 9-10 of October there, and the week of the 9th of October, that low is around 86. 12, 13 or so, just the one after. October, yeah, that one. There, where your cursor is, there, just next to that one. Must be 13 or so, yeah. So I think that
14,
for as long as we are below there, you're all right. But I think for the fundamental reason of the move, I don't know whether still it has a lot more legs. I do agree on the side in the euro, though, because I think the euro is perhaps a little more fragile than the sterling is right now. But I was just wanting to comment and saying that I'm out of it because I don't know in this zone. And as Ryan says, we're getting into a very important zone again. 85. Of course, you'll be out before because you traded relatively short term, but it is a big zone. Okay, Ryan, I can look at a few things.
Yep, okie dokie. All yours, mate.
Thank you. Okay, first of all, we are in Bank of Canada week, so let's have a look at what's happening in the Canadian dollar across the board, if you allow me to, because this is probably going to be the focus also because we saw big moves in energy market, oil markets. So we may see pretty decent moves here in the Bank of Canada week. So we had a quick look below 135 again, and it snapped back. So if you look at it here, we tried it here, we tried it. It's a bit of a fib level as well of the last leg higher. I'd say keep an eye on what's happening over the course of the week. If we retest this, call it 85 figure. If we get back below 134, 80, 85, we're probably going in for a test of the higher 133s, lower 134s. On the top side, there's a pretty decent area here that we broke it on the way down, and that is around 135.80, 135.90, 95. So that's your initial range to start the week, in my opinion. If there would be any, let's say, a relative strength in the dollar or overly weak Canada, then it is possible that we are going to have a look back at those higher 136s, 137 perhaps. But I wouldn't think that on a Monday right now that this is possible. It's more like this range here. An interesting one is Euro CAD. We had this big move lower. Also the acceleration, as you can see, the last 2 days of the month on a Friday, the acceleration as well that we had on the relatively good Canadian jobs report. But so far, we haven't been able to test the big support zone. To me, the really big support zone is going to happen. It's going to happen here, anywhere between 145.85.90 and 146.10.20. We have like a really cluster of trend line, moving averages. The 50% is around 146, the figure. So if you trade crosses and you look at the Euro Canada, this is going to be your big zone if ever we can get there. Because for now, also I think likely due to a snap or lower oil prices as well, and perhaps a second reading of that labor report, and as Ryan was saying, with this bit of uncertainty around it, and the unemployment rate did tick up a little bit, so we're having a bit of a move back higher. your first resistance should be around 147.5, and then I would keep a close eye on what's happening around 148, figure 10, figure 15. It goes back above there, even though we would still be below this wedge. I think the party for the cat may be over, especially because I'm not a huge fan of euro, and if a cross like euro cat can put in such a move, that means that there is quite a bit of Canada weakness in the system,
That
right?
one, that
Yeah,
one bounced right off our old magic level, though.
we have 6.5. Yeah, there's a few of
Yeah.
those, right? There's a few
Oh,
of those around, and you're right. Yes, we had a quick look below, and I think that must have been somewhere during the fixing time as well, where we had the acceleration, and then we bounced off it. You're right. Yes, yes, yes. That's a bit of a level here that we visited a number of times in the past as well, as Ryan says. Then there's one that the room is trading right now, and that is Cat Swiss. That's come a very, very long way. If you look at it, even historically, it's come a very, very long way lower, and we are on very long-term support zones. Whether it's been the past 6-7 years, we are on support, and whether it is even over the past 25 years, we are on. We are very close. Okay, this lower one is still about about 1% away, but we are on very, very important levels now. As we've seen those Swiss CPI numbers which came in lower, and looking at how Swiss really strengthened quite hard into the end of the month, there is a case to make here that we are close to a bottom, and some of us are trying to catch a knife here. And yeah, as Brand would say, and as Brand was asking me before, yes, I did put in my butcher's glove in a couple of Swiss pairs. So this one is I'm going to try and see if we get to see finally the bottom of this. It's always very hard because there's very little here that says like, oh, okay, we're starting to bounce. To be safer on this trade, we should start to move back above 66, above 67. But anyway, this is one where we're having a very, very close eye on to see what's going to happen in that one. Talking about the Swiss, then, sorry. There's this dollar Swiss. It came back to this support here overnight. There was a bit of a low liquidity trade as well. Now we're starting to get back above 87, 87.10. This is a level that I'm going to watch now. Also there, I'm trying the other side, trying to see if we found the bottom in that one. It's a bit of a tough one to really trade it, because if depending on which currency one would believe in, perhaps even Swiss yen would be your better one, as I said earlier, because of the yen finding some strength, and perhaps the Swiss now really has room, in my opinion, to weaken over the course of the next days or weeks, really, if S&P tells us it's enough. So that is another one that I'm watching here. I'm not going to get married to the position if really it breaks down prior these today's low, prior lows, low liquidity lows. I'm probably going to leave the ship and see what happens. But I guess it is worth giving it a little bit of a try. Ali, gold. Ryan already told what happened, right? This is a pure stop run. People coming in. Low liquidity, opening of the market. Algos, they do not think about whether it's reasonable or not to pay up. If they're short and they need to cover, they pay, and then they pay up the next offer and the next offer and the next offer. So I really think this is not a move that is, well, it has been real, but as I said in the room, I think they are still trying to sort out which trades should have been done and which trades should not have been done. So because if it would have been a real move, we would have been trading around 2100 or above, okay? And we are back sub the prior highs. So that is really what it tells me. So I've really start to watch those prior highs just once more. And then, of course, now we can add probably the 2100, which is a psychological level. If you really, if you really want to look for, there's not a lot above here, right? So I guess that technicals analysis will find perhaps a bit more levels around here, but it's really 2137. But really, I mean, it just depends whether this move continues to grind higher now over the course of the week, or if we're starting to see a bit of a setback. Again, today may not be your right day, as I said, because I think they're still trying to figure out which trades were real. Looking at the clock, that's it for me for today. Back over to you, Ryan. Thanks, guys.
Thank you very much, mate. As always, yep, that's the Monday show done and dusted. Hopefully, we've got you set up for the week ahead, and obviously, we'll keep you in the loop, in the picture as the week progresses. Have a great week, everybody. Trade well, trade safe. Watch your markets, watch your stops, watch your risk, and we shall see you all tomorrow morning. Thank you very much.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.